2023 was an absolutely brutal year for Enphase Energy, coming after a strong run of years over the past decade. 2023 was the year that residential solar started to go through a big cyclical downturn. I'm Jason Hall. This is Investing Unscripted. We're going to take a closer look at Enphase's results, what lies ahead for the business, and whether or not investors should be buying Enphase shares or running away from the company. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. It's fool.com/unscripted. The Motley Fool is going to give you its 10 best stocks to buy right now. Be sure to check that link out after watching this video. I'm recording this video on February 7th. The company dropped its earnings yesterday after the market closed, and you can see the stock spiked. It's up about almost 18% as of this recording in the afternoon. That's a great day for investors who have gone on a pretty tough run. So far this year, the stock is still down 11%. Over the past 12 months, the stock is down 47%. And from the 3-year high, from the peak of the stock, which was just at the end of 2022, the stock is down a brutal 65%, even after the big gains today. Okay, let's talk about exactly what's happened. I mentioned it in the preview, but the real core of the story here is that this is a great growth business in a cyclical industry. And over the past decade or so, residential solar has generally been really strong. And for Enphase, which core business is making the electronics that turn the DC power from solar panels into AC power that the grid operates on, past decade has been a story of massive growth and big time taking of market share. Now, I'm going to pull up the company's fourth quarter earnings release that's hot off the press less than a day ago and go through some key numbers to break down exactly what's going on. Before we go too far back, we'll take a little bit of a look at the most recent quarter. So we just got the fourth quarter results. Revenue was $302.6 million. That was a little bit less than expected, but some other things that were really impressive. Gross margin held up really well. Management on the earnings call said that they've been holding firm with pricing. They're not trying to discount to try to drum up more business. That's certainly paying off. Net income of $21 million, positive net income, positive $15 million in free cash flow, a giant pile of $1.7 billion in cash. They have a net cash position, very serviceable balance sheet. A couple things stand out. Operating loss of $10 million. We'll get into the details of how the company was able to be profitable, but also have an operating loss. We'll talk about that in a minute. But I want to take a look at the cadence of results over the past year plus and talk about how things have come down so much. We're going to start right here. This was the fourth quarter of 2022. $725 million in revenue. Compare that to the fourth quarter that we just heard from, the end of 2023, $303 million in revenue. Revenue fell by more than half. The other thing that doesn't tell the whole story, if you look at the third quarter revenue of 2023, so sequentially, revenue fell from $551 million to $302, continues to decline. Now, here's a closer look at the bigger picture story going all the way back to 2021. $302 million in revenue roughly in the first quarter of 2021. $302 million in revenue in the fourth quarter of 2023. So you're talking about basically giving up 2 years of growth is where things stand right now. Now, I got news for you. It looks like things are going to continue to get worse. It doesn't seem like the cycle for residential solar has hit bottom just yet. So I've gone back to the press release, and here's the company's financial outlook for the first quarter. And now they're saying revenue $260 to $300 million. Remember, just over $302 million in revenue in the fourth quarter. So they're saying that $300 million is the high end of their expectations for guidance. And remember, in the fourth quarter, that $302 million in revenue, management's guidance was for between $300 and $350 million. So they barely squeaked above the low end of guidance. Potentially another $40 million revenue decline. I want to talk really briefly about this right here, IQ batteries. This is a really important part of the business. Management says that batteries, home storage for residential solar, makes the revenue opportunity for every installation worth about 50% more. It is a really big part of the business. So they give us this number in megawatt hours. 70 to 90 megawatt hours is their guidance for the first quarter. Now, this is a little bit of a bright spot because if you go back to the fourth quarter results, just under 81 megawatt hours of IQ batteries shipped in the quarter. Now, that means that part of the business is remaining relatively strong. Yeah, still worse than we just saw, but the high end, it falls within that range, certainly not falling off as much as we're seeing that core microinverter business continue to struggle. Now, the next question that we want to talk about is this time for investors to be thinking about buying? Before we get to that, though, we need to talk a little bit about the balance sheet and the cash flows and think about how much worse could things get before they start to get better. So let's start back here with the guidance. And I want to start, we talked about the revenue, the expectation that revenue is going to continue to decline, maybe by another $40 million. But we also need to talk about the other side. Let's talk about the bottom line and operating expenses. Companies expecting to spend $144 to $148 million in OPEX. Now, adjusting out stock-based compensation and some one-time charges related to restructuring and asset impairment and stuff that's based around what they're doing to get their manufacturing footprint and their operating costs down, that's a smaller number, 80 to 84. But let's go with that 144 to 148. And let's compare that to their operating expenses in the quarter that we just saw. So operating expenses in the fourth quarter, almost $157 million. So that 144 to 148 puts it back in the range of what we saw in the third quarter and in prior quarters. In other words, they're taking some efforts to cut their spend, get their costs down. That's important because the company generated about a $10 million operating loss in the fourth quarter, as we talked about. How did it generate positive cash flow and positive GAAP net income? That's tied to some tax benefits around some incentives that were part of the Inflation Reduction Act that's now put into law that creates a lot of incentive for companies like Enphase to manufacture these renewable energy components in the US. Let's talk about that next. We have to dig in a little bit deeper and get into the operating statements, the financial statement, to see the exact benefit of the IRA. And they included those benefit down here. It's broken out in the fourth quarter, $25.8 million net benefit. So that's how you offset that $10 million operating loss and still report positive cash flows and positive net income, a big benefit from the Inflation Reduction Act. Now, let's talk about what their expectations are in the first quarter for a benefit from that. Something else they put in their outlook, you see it right here, net IRA benefit between $12 and $14 million. That's based on estimating 500,000 shipments of U.S. manufactured microinverters. So the key is they're taking advantage of this opportunity to leverage increased manufacturing in the U.S. They have a location in Texas, they have a location in South Carolina, and they're doubling down on those locations. They actually closed a facility in Wisconsin, they closed one in Romania as well. They're reallocating proprietary equipment that they use to manufacture their products into the South Carolina and Texas facilities so that they can begin to ramp up manufacturing capacity there as demand starts to return. That means they're going to get more of a tax benefit over time by doing more manufacturing in the U.S. Sure, it's offset a little bit by closing the Wisconsin facility, but closing that Romania facility is going to allow them to help leverage the IRA. And then by closing those two facilities overall, they should get some operating leverage benefit of maximizing two facilities. Out here, they might not necessarily see all the operating leverage benefit because it's third-party contractors that operate those facilities on Enphase's behalf. The point is, they're taking steps to lower costs while also leveraging the IRA and positioning the business for when growth does recover, when the market does recover, they're ready to grow along with it. Let's talk about the balance sheet really quickly. So Enphase still managed to deliver net income and positive cash flow in the fourth quarter, largely based on the benefit of the IRA that helped offset that small operating loss that the company generated. But the good thing is that it's in a really good position to be able to ride out the volatility of the market. And even if revenue continues to decline and their ability to cut costs enough to offset the lost revenue doesn't result in continued profitability, the company's built to ride things out just fine. If you look here at the top, just about $290 million in cash, $1.4 billion in marketable securities. That's basically short-term treasuries. You're looking at about $1.7 billion in liquidity that they're sitting on right now. Let's go down here to liabilities. It is worth noting that there is about $1.3 billion in debt. The funny thing is that they're earning more in yield on the cash than they're paying to service the debt. So that's a great position to be in. The key thing is that there is a tremendous amount of net cash and total liquidity that they have access to be able to ride out this downturn. Okay, so we've talked about the state of the market. Solar market's in bad shape right now. We've talked about the reality that we haven't hit the bottom. Management says they think the bottom is going to happen in the first quarter, but we do know that the results are going to deteriorate. We also know that Enphase is taking steps to shutter its contract manufacturing facilities and try to start repurposing and maximizing a facility in Texas and facility in South Carolina so that when the solar market does start to return, they have the ability to ramp up production and continue to take market share and go back to growing when the market does go back to growth. Put all that together, and should investors be looking at Enphase as a stock to buy right now? I think in general, my answer is yes. I don't think this is necessarily a time to load up or back up the truck, but I do think this is an opportunity to maybe start accumulating shares. I did another video with Tyler Crow. Enphase was one of the two stocks that we talked about, and I indicated at that time that I thought starting to accumulate shares with Enphase might make more sense. In this deeper dive video, I want to highlight why I think that is the case a little bit more. Now, we're going to anchor a little bit here. I'm going to go back to the beginning of 2021. So we talked about the revenue levels that we're seeing for the company now. And basically, we're back to 2021 revenue levels for Enphase. The stock is actually below those levels and is down 32% from where it began the year back in 2021. Now, there's a caveat there. Back in 2021, the market was expecting growth. And of course, we saw tremendous growth. Revenues more than doubled over the next 2 years. Enphase also rolled out its batteries. It's been very successful with its batteries and also grew its gross margin, increased its cash flows over that period of time. So where we are now, the stock down so much, down 32% over the past 2 years and down even more, down a brutal 65% from the highs. The market is not expecting very much going forward. That means that now is a good opportunity to start building out a position. I can't guarantee that the stock is just going to go up from here, but I can guarantee it's going to be really volatile. That means there could be even better opportunities to buy the stock. Only the market is going to show us that over time. But I do believe that investors that start a position look to accumulate on continuing strength with Enphase, the business, its ability to adapt to the market, the strength of its balance sheet, holding firm on its margins, continuing to deploy more batteries and expand geographically around the world. Once the solar market does return to growth in residential solar, Enphase is going to be positioned really well. And then I expect over the long term, the stock is going to do really well too. So investors that invest in Enphase during these weak periods and look to hold for the long term are probably going to be super happy that they did.